Okay, welcome everybody. Thanks so much for joining us for this very special webinar. I'm Sean McKay with American IRA, and today we're going to do something a little bit different. Typically, you have to tolerate me speaking about self-directed concepts as it relates to buying real estate and other alternative assets. And so from time to time, we're lucky enough to have subject matter experts that can educate us more fully on specific strategies. So today we're lucky enough to have Chris Larsen with us, who is the client relations specialist for Cannell Capital Partners. Chris, thanks so much for joining us.
Thank you, Sean. Happy to be on here with you today.
Absolutely. Yeah, this will be great. So as I said, today's format really is kind of split between two mini concepts, if you will. So as I look at the list of the registrants, there's actually a number of individuals who are at least not clients of American IRA as it pertains to self-directed retirement accounts. So we'll spend the first few minutes just kind of talking about the big picture about the self-directed accounts and what they are so that you have a bit of background as we discuss this commercial concept, and Chris is going to educate us on the world of apartment buildings and how to invest in multifamily. Excuse me. I'm going to apologize ahead of time. The allergies are a little rough here for me in the Carolinas this time of the year. I do want to make sure we have the proper disclaimer here. I've known Chris for a number of years. I've learned a great deal from him about real estate. And so certainly I think he's a phenomenal resource for us to put in front of our clients and potential clients. Certainly with that being said, I do want to make sure that we're clear that American IRA is actually not in any way promoting Cannell Capital Partners, Chris Larsen, Pete Cannell, who is the principal of Cannell Capital Partners. We're not promoting for our clients to invest in their opportunities. Excuse me. And so ultimately, we're bringing them on as a subject matter to speak very intelligently about the world of apartment buildings. But again, American IRA is not making any sort of suggestion that you should, in fact, invest with them. We will have a contact us slide at the end of the presentation. So certainly, if you would like to interact with them moving forward, you have the ability to speak with Chris and their team over there. But we are not attorneys, we are not CPAs at American IRA, and certainly we must always stay neutral in our clients' investments. So look forward to a lot of great education today. Just wanted to kind of set the table for what this will look like today. So as we look at self-directed retirement accounts, certainly a lot of individuals are aware of some of the opportunities that are available to them with their IRAs and 401ks. And depending upon your risk preference, that can be very safe concepts such as money markets and CDs to more aggressive concepts such as bonds and mutual funds and certainly individual stocks. And for many people, that's a great solution. And certainly if you're looking to be passive with those investments in terms of the decision making and working with financial advisors, that can be a terrific way to go. However, the benefit of the self-directed concept and why clients decide to do business with us is just simply that they're looking to take advantage of a alternative asset-based opportunity. So clients are able to use that same IRA and 401k, as we'll see, to invest in what we consider alternative assets. So as I mentioned, today we'll be discussing apartment buildings. So your retirement account has the ability to invest in apartment buildings just as it can in stocks, bonds, and mutual funds. So ultimately, the way the IRS code is written is it simply tells us what we cannot invest in. It does not give us a list of asset classes such as stocks or real estate, anything of that nature. It just simply tells us we cannot invest in life insurance policies and collectibles. So as long as you are not investing in either of those, you're typically going to be in really good shape. So ultimately, alternative assets is really the benefit of the American IRA service. And thus, some clients are looking to fully invest in these self-directed concepts, and for others, it's just simply a way to truly diversify their portfolio. As we've seen with different economic cycles, the stock market may be down at different points, the real estate market may be down at different points. So ultimately, we're offering an opportunity for full diversification for our clients. So when we define a self-directed retirement account, I think of it as two components. The first is that, as the name indicates, you are the decision maker as the account holder. As I like to say, you are the captain of the ship. It is truly self-directed. So this is a departure from working with a financial advisor who may be picking certain investment products for you, whether they're mutual funds, annuities, etc. In this self-directed concept, you are the decision maker, and certainly you may lean on other individuals to help you in making those decisions, but American IRA, as your financial services firm, is not suggesting investments or opportunities to you. So the second concept is, as I mentioned, really we are not the best provider for individuals that are just simply looking to invest in the typical securities world with stocks, bonds, and mutual funds. The benefit of our service is what we consider the alternative assets. So that is the retirement account directly purchasing assets such as real estate, mortgages, private placements, and precious metals. Now, at American IRA, we are technically the third-party administrator for your retirement account. And so what that means is that we are essentially the record keeper for your IRA. And so ultimately, when your IRA is making an investment, whether it's stocks or real estate or precious metals, you need to have a financial services company that is keeping the books for the asset. And so ultimately, as I mentioned, our specialty are the alternative assets. So we are not really direct competition for the large traditional financial services companies like a JP Morgan, a Wells Fargo, for example. Excuse me, because although they're great firms and they can be a great resource for you, they're not able to assist you with these alternative assets. And thus, we kind of provide a niche service, if you will, in financial services, but certainly an important one for those that are interested in these alternative assets that we typically discuss. Now, we are what's considered a fully integrated company, meaning that American IRA is the third-party administrator, and New Vision Trust Company is our custodian. We have the same ownership group for both firms, thus being fully integrated. And certainly, we're here to serve our board and to make sure that all elements are in compliance with New Vision Trust and the state of South Dakota for compliance reasons and things of that nature. But ultimately, we are fully integrated, and it allows us to be able to control our own destiny, because what you'll find is that many self-directed firms have a third party as a custodian, which means that they can be served notice at any point in time and have as little as 60 days to find a new custodian to be able to stay in business. So ultimately, our principal, Jim Hitt, has done a fantastic job of kind of insulating us, if you will, from those potential hazards, which I think certainly benefits our clients as well, with kind of being assured of maintaining a custodial relationship, if that makes sense. So we're never going to be one of those traditional financial services firms with millions of clients. As I mentioned, we're a boutique provider, so we're kind of like the local bank, if you will, as it pertains to your relationships. And I think that that's nice, because as you look at our firm, most of our department heads and many of our employees overall have been with our firm for 5, 6, 7, 8 years. So there's a lot of continuity amongst the American IRA staff, which I think is also very helpful. And as I said, I've learned from individuals such as Chris Larsen, Pete Cannell, and a lot of other investors, because we're investors ourselves and we love this idea of self-directed, of investing, of real estate. And I think that helps us to be a value add for our clients as it pertains to general educational concepts. So hopefully you'll feel as though there's a lot of value in what we're sharing today on the apartment building concept and commercial real estate as a whole. Now, when you look at self-directed accounts, it's important to note that the retirement account itself is actually not changing forms. So if you currently have a traditional or sometimes called a rollover IRA with, we'll say, Wells Fargo, for example, and you decide that you're going to just simply move a portion of those monies to us at American IRA, you're still technically going to have a traditional IRA with us at American IRA. So you'll have the same rules and regulations that you would with American IRA as you do with Wells Fargo or any other financial services company that can administer an IRA or a 401k for you. So the retirement account itself is actually not changing forms. So please keep that in mind, that even though we use the term self-directed, ultimately that's really just kind of a marketing term to make you aware we are not advisors picking products for you, and you certainly can invest in alternative assets. So everything from Roths, traditionals, SEPs, simples, Coverdales, inherited retirement accounts, these can all be self-directed retirement accounts. Now, certainly, as I said, the juice of the presentation today is getting into this apartment building concept, and Chris is going to do a great job explaining how that flows for us. But just keeping in mind, if you look at the options available to us as investors, really, as long as it is not collectibles and life insurance policies, many times these assets can be acquired by our retirement account. So anything from raw land to condos, townhouses, single family houses, all the way up to commercial type of products such as apartment buildings, industrial buildings, retail shopping centers. These can all be directly owned by your retirement account. Now, also, we see clients that like the concept of real estate, but they want their retirement account to just simply provide a debt instrument. And depending upon the state that you live in, that will typically come in the form of either a mortgage or a deed of trust, which is sometimes used interchangeably, frankly. But that's essentially being the bank for other investors so that they can buy different investments, a rental property, do a fix and flip deal, or lend money to someone who's going to buy a commercial property, etc. Now, also, I wanted to highlight the idea of LLCs. That is an option for clients at American IRA. So there's really kind of, in my mind, two components to the LLCs. There's the single member LLCs, and you may have heard the term checkbook control, where the retirement account becomes a member of the LLC. And then depending upon the structure and guidance that they've received from their attorneys, sometimes the account holder, sometimes third parties are the managers of that LLC. And that gives them the ability to use the retirement account in a different facet and in a different structure than our typical clients that interact with our office for each purchase and sale of assets. So certainly that's a big topic and something we can discuss with you at a later date, but we do get that question a lot. Do you guys offer checkbook control? The answer is yes. It's not a mandatory activity for our clients, but it is an option. And then certainly there's the idea of multi-member LLCs. And I believe Chris may touch on this today, where essentially retirement accounts can become a member, one of many members in a LLC that is going to go on to purchase an asset such as an apartment building, for example. So retirement accounts can be members just as individuals can. Excuse me. So what I'll do now is I'm going to go ahead and turn this over to the presentation that we have for Chris. I apologize, we're on different platforms. Also, I want to make sure that we understand that there is a questions box. So certainly if you are if you have any questions about my presentation or Chris's, please feel free to type that in, and we'll be sure to get to those at the end of the presentation. Okay, Chris, I have attempted to turn this over to you. So again, Chris Larsen, who heads up investor relations for Cannell Capital Partners. Chris, I believe the screen is all yours.
Thank you, Sean. Let me just make sure that we can do this here. All right, terrific. So, Sean, thanks for the introduction, and I appreciate you doing the overview. You know, I'm a fan of what you guys do. Today I'm going to be talking about what I like to call next level income, which is the title of an ebook that at the end of the presentation today, I'll share a free copy with everyone. And the subtitle is Moving from High Income to High Net Worth Using What I Call the Holy Grail of Real Estate to Achieve Financial Independence. And I'll tell you why I think it's the Holy Grail. But before we get to that here, this is not an offer to sell securities. I'm not going to be presenting any offer today on any of our properties. But of course, as Sean said, I will provide information, contact information at the end if anybody wants to learn more. So before I get into it, I will introduce myself. Peter Cannell, who's sitting with me here today, presentation, but Pete will be available for questions at the end if anybody has any questions. Pete Cannell founded the company back in 2015, Cannell Capital Partners, and I joined him shortly thereafter in the fall of 2015. And we've been together now for over 3 years, but we've been friends for 22 and a half years, right, Pete? Yeah, since literally the weekend I started college. And we both have about 20 years of real estate experience apiece. We've been investing since 1999. We started in really residential real estate, as a lot of you probably have either knowledge or experience just doing residential rentals or spec building. But since that time, we have moved into a lot of different areas as far as commercial real estate. We've also done private lending. We've done vacation rentals, self-storage, a lot of different facets, which I outline. We both were engineers by education. Pete spent about 15 years in cybersecurity. I spent 15 years in the medical device, but the whole time we've both been real estate investors. And about 5 years ago, we transitioned really exclusively into commercial real estate, but more specifically, the multifamily space. I got a little lag here, so forgive me as I catch up with the slide. So today I'm going to be talking about financial freedom and my definition of financial, why I think multifamily is a great investment space today and why it's going to be a solid investment class going into the future. And then I'm going to talk about Cannell Capital Partners and our multifamily investing strategy. So I imagine a lot of people on the call are familiar with American IRA. And if you're on this, or if you're on this webinar, you probably have an interest in becoming financially independent. My definition is people that have assets that generate an income greater than their expenses. And I would add something to that, which is it'd be great if these investments were passive. So if you can't walk away for a year and have your income continue to stream in without your input, I would say that's not really passive. That doesn't necessarily mean that's the only way to obtain financial freedom. But if you desire to live life on your own terms, I think the best way to do that is with passive placing your asset, and you can focus on the things that are important to you and either the causes, your family, your career, whatever that may be. Sorry, I'm getting a little lag here, Sean, on the input. So let me try to back up one slide here. All right, so I'm going to talk about 3 topics today. There we go. So why multifamily versus residential real estate, for instance? Yeah, this is giving me a little bit of a lag. I'll have to do it off my memory here. So first off, as I stated, I began investing as a residential real estate investor, had residential properties that I rented out. And there's some differences between multifamily and residential. So multifamily is basically apartment buildings. And the big difference between residential properties and apartment buildings is if you invest with a group like us, you're going to have a 100% passive involvement. So you don't have to get phone calls in the middle of the night, over the weekends, during the day. I even got phone calls during my honeymoon, which my wife can tell you I was not very pleased about. Also, you get a lot of tax advantages if you're a high income investor. So if you're an accredited investor, which is defined as $200,000 of income or greater if you're an individual, $300,000 as a couple, and or have, and I say or, a net worth of $1 million without your personal residence, you're considered accredited. And a lot of times you phase out of some tax benefits of owning real estate. If you're in one of these buckets, you retain those as a member of properly structured LLC. I will add a caveat. We're not tax professionals. I'm not a CPA. And after today, if you have any questions that are tax related, I would go to your CPA. I'm probably not going to answer any tax related questions during the question and answer session either. And if you do consider this space, you should talk to an investment professional in general. And then number 3 is your investment return scale. And what I mean by that is most people don't want to own 20 or 30 or 40 different homes that they rent out. They want the benefit of homes. So multifamily is nice because you can buy a $5 million property, you can buy a $15 million property, you can buy a $50 million property, you can buy a $500 million portfolio, and you can execute in general the same strategy. And at the bottom here is a bonus: the debt is non-recourse. So what I mean by that, or the definition of that, is that you don't sign personally on the loan. The nice thing is if you have a large apartment building, the debt is going to be backed with the collateral that is the building and essentially the business itself. So why, as an investor, would you consider the multifamily space? What are you going to get from it? You're going to get cash flow. You're going to get typically quarterly checks. You're going to get controlled appreciation. And I would add controlled appreciation. And that's because these buildings are valued on net operating income. So the difference is if my house that I have is let's say it's 2,000 square feet and it's worth $200 a square foot, it's worth $400,000. If, as we saw during 2009, the price goes down to $150 a square foot, the price of my house drops to $300,000. And it could go up. It could go up to $300 a square foot. It's solely based upon market forces, what your neighbors' houses are worth. Appreciation in the multifamily space is from the increase of net operating income, and that's how these properties are valued. And then last, I say it's the cash flow, the appreciation can be wrapped in tax benefits if they are properly structured, and I'll talk a little bit more about that. So what do? At Cannell Capital Partners, we acquire 150 plus unit B-grade multifamily assets, apartments. We improve them, and what I mean by that is we increase rents, decrease expenses, which drives net operating income and in turn the value of the property. And then we look to sell. And I'll add something else here. We really look for a liquidity event. So that means we could do a supplemental debt or a refinance, or we could sell. So I'm going to talk a little bit about how we drive value. So when you buy any type of commercial real estate, you have a certain amount of income. So in our case, we have a certain amount of rental income that's coming in when we buy a property. And if you subtract the expenses from that property, you're going to get net operating income. So we do 2 things. We buy properties that have below market rents. So some people may be thinking, why would somebody that has an apartment building have rents that are below market value? And if anybody on this call has owned a residential property, it's usually harder to rent a property if your rents are at market or above than if they're below market. So if you're an owner operator and you're at 100% occupancy, maybe you're okay with that and you don't want to deal with the headaches of dealing with 95 or 90% occupancy, even though you may have NOI. So we work with a fantastic third-party property management company. They manage over 60,000 units, and they're very skilled at keeping rents at market levels and driving those rents to market levels. So we do a couple things. We're gonna rent up to market level. That's going to drive top line income. Then we're going to work very closely with our property management team to try to lower our operating expenses. The other thing we're going to do is we're going to inject capital. And what that's going to allow us to do is we're going to improve the property. So we're going to make exterior improvements. We're going to make interior improvements. If some of you were wondering a couple minutes ago, I mentioned we're buying B-grade assets. These are typically built in the 1980s, late 70s, maybe early 90s. But a lot of these have deferred maintenance. Maybe they don't have great landscaping. Maybe they have tennis courts that nobody uses anymore. Maybe they in furniture that nobody wants to use. Things that we can easily go in and repair with some capital that we've raised from our investors. That allows us to do is increase rents up to the level that we'd see in newer properties. I'll let the slides catch up here. And then we're going to, once we have those rents up to market level, with our capital improvements in place, we're going to look to optimize management. And what that's going to allow us to do is lower our expenses. Let's see here. Forgive me here. There we go. So the difference with the new rents minus the new lower expenses is going to be our new net operating income. And if we can control the net operating income, we can in turn control the appreciation of our property to a degree. So that's a little overview about what we. Next question that I'd like to answer is, why would you invest in the multifamily market? Why is it a good long-term investment? The reason is it's fueled by population growth and renter mentality in this country. And what we look at first, if you go from the top down to the bottom, is we're going to look for great markets. We're going to look for large markets that are growing faster than the national average. So we want to look at markets that have an influx and have demographics, large populations of baby boomers, of millennials, population or cities that don't have a lot of supply. So we can buy properties that are in place and know that there's going to be a consistent demand. And then, the other reason you're going to want to look at the multifamily market is the favorable risk profile. So let's take a look at the long-term demographics seen since the housing crisis began is a decline in home ownership rates. Many of you may be familiar with that. But if you go back, you see that over history in this country, we typically saw home ownership rates in the low 60, maybe 65% range. And this is true across the world in developed countries. That went up due to the favorable policies in the 19 for home ownership to nearly 70%. But since it's fallen back into those low 60s, trends are why we start to talk about the renter nation that America is becoming. And the reason we call it renter nation is because if you look at every age group up until you hit about 75 or higher, you're going to see an increase in households that are renting. Now, a lot of people could probably figure out when you hit 75, these individuals are either moving into assisted living facilities or maybe they're passed their assets on to their heirs at that. But in every other age, share of renters is increasing. If we look at the 20 to 35-year-old age cohort here, it's been on a steep increase over the past 5 years. That's going to continue for another 5 years. And while it's going to level off, as you can see, it's not going to drop back below the levels that we're seeing today. And it's going to continue to increase, not only due to favorable demographics in this country, but also due to migration into this country. And migrants tend to be overwhelmingly renters versus owners. What's intriguing is since I first did this presentation about two or so years ago, maybe 3 years ago at this point, the fastest growing demographic today is this last bar down here, which is over 55 category. So these are your baby boomers. So baby boomers today are becoming empty nesters as their children move out. They're also wanting to unlock the equity in their home because, as many of you know, you can't spend equity. You can only spend income, or you can spend cash that you have in the bank. So baby boomers like my stepfather sell their house. Maybe they downsize or they move to becoming a renter. So that means you have this dual-headed monster, if you will, that's driving renters between the millennials and the baby boomers. And these are the two biggest demographics over the last century that we've seen. It's really amazing. So demographics are great today. They're going to be great for the next couple decades, even longer than that. So if you take a dive into the numbers behind the question, why should real estate be a part of your portfolio? My MBA is in portfolio management, and one of the metrics we talk about is the ratio. The Sharpe ratio, in kind of layman's terms, is simply risk-adjusted return. So if you look at this slide, you're going to notice what is labeled NPI. NPI is basically an index of income-producing commercial real estate. And what this is showing on the x-axis is your risk, and on the y-axis, your total return. And really the thing I want you to take away from this slide is that income-producing commercial rate is going to have a risk around bonds with the return around stocks. And this is why I like to call this the whole, you're going to get what you're going to see here in the next couple slides, an increased return with a decrease in risk. This slide is taking that x-axis of risk and turning it on its y-axis. It's going to compare, again, commercial real estate to bonds in terms of risk. And what I want to highlight here is all the way on the right-hand side, REITs. Some of you may be thinking, why own REITs? That's it. Get real estate in my portfolio. It's liquid. I can sell it whenever I want. The interesting thing with REITs is they're highly correlated with stocks when it comes to risk. So it does not give you a great difference in risk-adjusted return when it comes to an overall portfolio. And that's what I'd like to show here is a couple sample portfolios. So if you take a portfolio, your typical stock and bond portfolio, and Sean, my guess is this group is probably a little more sophisticated than your average investor, which is why they're on this call.
Mm-hmm.
But there's a lot of investors that have nothing but stock and bonds in their portfolio. Well, if you add commercial real estate, and this slide shows up to 20%, you're going to see an increase in ratio over the initial portfolio A, of about 25%, going from 0.61 to 0.75. And this is why I like to call this the Holy Grail. This is really the money slide here, which is what Ray Dalio, who by many accounts is the most successful hedge fund manager of all time. Some put him up above Warren Buffett even, but he says an increased return with a decreased risk is the holy grail of investing. So that's where we get that title from, if anybody would. And I think another thing I'd like to point out, the Family Office Club, which is a group of ultra high net worth families, about $100 trillion worth of assets that are associated with that. They took a poll, and families that not make their money in real estate. So these are families that made money in other businesses, everything from oil to technology to biotech, railroads, those sorts of things. They hold about 20 to 30% of their family's net worths in income producing commercial real estate. So when I heard that figure, I said, hey, I want to be ultra high net worth one day. I might as well start investing like an ultra high net worth investor. So that's a great trick. So we've talked about demographics. We've talked about why it's going to drive multifamily and stabilize multifamily over the next 2 decades. We've talked about how it would integrate into a typical portfolio and help increase return and decrease risk. So let's talk about a successful multi-investing strategy and really we do day-to-day at Cannell Capital Partners. So first and foremost, when it comes to buying commercial real estate, you want to look at the market. And Pete and I like to say, you can't move your apartment. So you might have a beautiful apartment building. The numbers may look good on paper, but you're in a market that's seen decline. I'm not going to point any specific markets out. But we've seen some markets in this country that have skyrocketed over the last 10 years. And we've seen some that have gone nowhere or even gone down. And you can probably picture some of these markets in the upstate New York or Midwest areas that just have stagnated, that are seeing declining populations. So that's in the middle here. Population growth is one of the number one things we look at. Job and wage growth. We want to look and make sure that job, wage growth, and population growth are all above national averages. And we're looking at big cities, typically 1 million or more in populations, like Atlanta. And then what we do is when we identify these markets that we feel are going to be strong over the next 5 to 10 years, we go into these markets, we build relationships with owners, with brokers, with other individuals in the industry, because it's still a relationship business. And any of you from the South know that even in the South, it's more so relationships than other areas of the country, for instance. And then we look at asset selection. So we identify a market. Then we're going to look at the submarkets. So Atlanta, for instance, has 33 different submarkets. Some of these markets may have been hot over the last 5 years, like downtown or midtown, and they don't make sense to invest in right now because they've been overbuilt. Where maybe you get out into the suburbs, which are coming on in a few years and have really good numbers. And then you're going to drill down to the neighborhoods. One of the metrics we look at is average income. And the reason is if you have a low average income, you're probably going to have a low top end rent in that market. So we want to be in submarkets and neighborhoods that are going to support increasing rents and are going to look for newer product or upgraded product. We're going to look at the T12, which is a trailing 12-month income. We're going to look at rent rolls. We're going to try to see if any of these properties are going to meet our initial back of the napkin metrics. If they do that, we're always in the market. Pete's down there every other week. I'm down there almost every month, if not more. We're looking at different properties, and if we identify to put offer on, we're going to go through the property, bring our property management team in there. We're also going to tour competing properties and going to see what else is out there. Again, talking about that supply and demand, we like markets that have limited supply, that we know we're going to have favorable trends. And then we're going to financially model the asset that we're looking at. We have a massive spreadsheet. We look at a ton of different metrics. We work very closely with our property management team to make sure that our assumptions that we put in place are going to allow us to increase that net operating income in a predictable fashion. Once we have put an offer or acquired an asset, now we're going to take a rapid approach to maximize value. Pete and I aren't very patient people. We're former elite athletes, and we want to make sure that whatever we're doing, we're continually trying to do it better, and we're doing it as efficiently as possible. I mentioned earlier, when we buy an asset, we also raise capital to improve the asset. First thing we're going to do, we're going to have a plan in place before we even close. We're going to immediately begin to put new signage in place, new landscaping. We may be putting new roofs on our most recent acquisition from July, right, Pete? So, I mean, we're going to, I mean, it's been 2 months, we're already putting new roofs on this project. So we're going to move very rapidly with that. We're going to work closely with our management team, with sophisticated software that's going to allow us to tick rents up or down on a daily basis to optimize based on seasonality and vacancy. And then I have tax optimization here. We're always going to do this through the filter of doing it in a tax efficient way. We use a sophisticated concept called cost segregation. And many of you may be familiar with the straight line depreciation on residential real estate of 27.5 years. What we're going to do is we're going to try to accelerate that. If you have a lot of appliances, if you have a lot of HVAC units, and many of you are thinking, yeah, if you have 150, 200 units, you're going to have those in every single unit. You can depreciate those faster than 0.5. And what we want to do is push that depreciation forward. So that's going to allow our investors to keep more of their income early, and that's going to help increase their IRR on their investment. And we have a very hands-on approach. So we manage the managers. We're on weekly calls with staff, sometimes daily calls. If we're getting into a property early or we're trying to tweak, for instance, we're down there on regular announce visits, but sometimes I'll pop in, take a look at the property, make sure that everything's presenting as it should be, to try to get a feel for what a prospective runner might be. Last trip I took down there, I took my sons to Atlanta to see a Braves game, and I took my wife with me, and I said, hey, what would you think if you drove up to this property? Get kind of an outside perspective from people that may not have an inside look to see what it might look like, and we can provide that feedback to our management team and make iterations and changes. We also sometimes mystery shop our properties or other properties, again, to do the same thing. And last on here are our investor communications. So I mentioned very early on in the presentation today that this is a passive investment. What's nice is our investors have 100% transparency in the financials. They can look at the monthly financials from our property management company, but they don't have to worry about them day to day. They get a nice summary every quarter. They get the monthly financials. They can hear from us if there's anything exciting or concerning going on, and they can trust in us that we're going to address that on a day-to-day basis. So that's from a management perspective, how we unfold the strategy. So then many of you may be asking, okay, I understand the cash flow component of owning a piece of real estate. How do I get my capital back? So what this chart shows is a sample cumulative return. And what's most important is the 3 to 5 year slice here. And if you think about purchasing a large apartment building, you move in, you stabilize it, you make your exterior improvements, you begin to turn the resident base. Maybe there's residents that are delinquent, or maybe they're dangerous for some reason, and we want to improve the overall neighborhood feel, but also the financials of the property. We take us a couple years with the turnover of residents to improve all the interiors that we want and really bring that income up to the level that we want it to be. Once it's there, we're going to have a nice, clean, trailing 12-month income statement that we can show to a bank to do a supplemental debt line or refinance, or to show to a prospective buyer. And term holders of real estate, let me be clear of that. We buy B-grade value add properties that we can hold for 5 to 10 years, but we're going to be opportunistic opportunity to return capital early and above projections to our investors. And the way we do that are through a couple different liquidity events. One would be that supplemental debt or refinance, and two would be a sale. And I say 1031 exchange. So for anybody that's not familiar with this, I can dive into that on a separate call. But we don't want to stick our investors with the problem of having a big slug of capital to them without a good place to put it. So if at all possible, if we dispose of a property, we're going to look for another property for them to leverage up into. So this would mean potentially selling a $10 million property and purchasing a $20 million. That means that our investors now get increased cash flow, they get more stability, and they get to continue to leverage their investment into the future. So why work with an operator like us, a syndicator of these apartment buildings, versus doing it on your own? So this is something that Pete and I lived through ourselves. We were investors in this space about 6 years ago, 5-6 years ago, and we went through the process of raising capital and getting our own deals. And the reasons that you can't just jump into it typically is because it's a very relationship-oriented business. Some of our relationships we've been building for 2 or 3 years, and they're just now coming to fruition. You also need high levels of capital. The last property we purchased, we raised $6.7 million. So it's not something that typically 1 or 2 investors can do unless you're already in the space and have millions of dollars liquid and ready to go. And lastly, you need experience. A big part of a successful multifamily strategy is having long-term debt in place. And what we use is Fannie Mae or Freddie Mac debt. You're not going to be able to get these types of products unless you have a track record in property management. So while Pete and I had 35 years of investment experience in real estate, we did not have long-term management in apartments. And we built that over the last 5 years. And now we're able to get very solid, favorable debt on our properties to allow us to have that in place for our investors. So what do we do at Cannell Capital? We give individual accredited investors access to multifamily real estate investments. And in turn, our investors get cash flow. They get that controlled depreciation like we talked about, and they also get those tax benefits in most cases. So if anybody has questions, Sean, I'm not sure how much time we have allocated today, but Pete and I are here for questions. You can also send me an email or give me a call to schedule time to talk. And Sean, I think we're going to coordinate a way where I can send my ebook to everybody that was on the call today. Is that correct?
That's correct. Yep.
You still there?
Yeah, Chris, can you hear me?
I can now.
Yeah,
but
you'll be able to
saying I'm happy to provide a free copy of my ebook to anybody that was on the call today.
Perfect. Appreciate that. Excuse me.
Excellent. And I'll add one last thing. Anybody that's also interested, we were featured in a book called Multifamily Investing, the handbook for raising net operating income on apartment building investments. And if anybody wants that, they can send me an address and I'll send them a free hard copy of that as well. So a couple nice giveaways today, Sean.
Perfect. Thanks so much, Chris. And yeah, obviously, as I said, we're working to bring experts in different fields, and Chris certainly adds the expertise that I'm not able to add to the multifamily discussion, as I purely play in the 1 to 4 unit arena. So, Chris, I really appreciate that. So, what we'll do is, again, we have a questions box. And so we'll give everyone a few moments to get into that. I do see a few coming online already. So again, we do have, hopefully you can see the final slide here with the contact us information. And so again, that was Chris Larsen with Cannell Capital Partners. And also, again, I'm Sean McKay with American IRA. The easiest way to reach me is going to be via our Asheville office. And I apologize, I actually need to change the slides here to the contact us. Okay, perfect. Great. Again, okay, perfect. So again, Sean McKay, American IRA. Email is Sean, SEAN, at AmericanIRA.com. Again, our headquarters is in Asheville, North Carolina. That's where our processing is done. We do have sales team members over there as well. And that phone number is 828-257-4949. And Chris Larsen with Cannell Capital Partners. It's C. Larsen at cannellcapitalpartners.com. And the number is 828-768-8700. So again, if you're, many of our clients happen to be in the Southeast, Chris and Pete are both located in North Carolina. And as Chris mentioned, a lot of their deals tend to be in the southeastern region, if you will. So we'll go ahead and start digging into those questions. Chris, if you don't mind, I got 12:46. If you can at least spare till 1 o'clock, that would be ideal. Okay, perfect.
Absolutely.
Thank you.
And hey, Sean, just a quick reminder, I also have Pete here with me, so I'll open it up to both of us if people have specific questions.
Perfect, great. So Pete Cannell is with Chris as well. Okay, great. So first question is, will this be recorded so that we can go back to it? Yes, this will. So I apologize, the audio has been a little bit spotty today, but hopefully it's been sufficient to at least retain the information here. But what we will do is we'll upload it to our platform, and we'll actually send the recording to everyone that registered for the webinar. Actually, one of our most sought after webinars in 2018. So obviously that's the subject matter, and Chris and Pete that are driving that. So great stuff there. So yes, we will send those recordings out. Okay, let's see. Okay, so this is going to be, I presume most of them, frankly, will be for Chris and Pete. So the question is, what's your targeted LTV, exiting strategy, allow 1031 exchange? Thanks.
All right, so let me repeat that. So the question is, what's our LTV? And then what was the last part about the exit strategy, Sean?
Correct. So kind of a three-parter. So if you can give us the targeted LTV for properties, what is your exit strategy? And if you can recap again, if you allow for 1031 exchanges through your group.
Sure. So we're typically buying at LTVs between 70 and 80%. We've tended towards the lower side of that. Our exit strategy is we are going to let that revolve around the period of the debt. So, for instance, if we have 10-year debt on that, we're going to make sure that we're comfortable holding that for the full 10 years. But as I mentioned, and I'm not sure if it cut out, or just to kind of highlight that slide, we're going to be opportunistic sellers, typically in that, plus or minus 5-year time frame. And then the last question, or the last part of that question, was, do we allow for 1031 exchanges? So kind of a caveat. So we don't typically take individual 1031 exchanges coming into a property. We've entered investors, I'm talking about $1 million plus, but we will look for the opportunity to do a 10 exchange so our investors can leverage their investment going into the future. Does that answer the question?
Perfect. I think you nailed it. Great. Okay. So the next question is, what are some of the risks involved in a typical deal, and how do you mitigate those risks?
Yeah. So I'm going to let Pete have a turn here. So the question is, what are some of the risks involved in these deals, and how do we mitigate those risks?
Okay, thanks, Chris. Yeah, so good question. And some of the risks involved in this type of asset class are similar to what you have with any piece of real estate. But in our space, where we see some of the biggest risks around operations. And so one of the things we like to look for is a poorly operated property when we're buying, because we can come in and fix a lot of those issues. But if you're not a good operator, if you don't have a lot of experience, it's not. That's generally where I would say the most of the risk is just not being a good operator. And so we mitigate that risk by having a really excellent property management team with decades of experience. And as Chris said, about 60,000 doors under management. So we're in good hands there.
Yeah, I'm going to add one other piece to that. So I would also say the debt. So if you look at some operators, they're putting on short-term debt, like 2-3 year debt, and they're artificially instigating a risk there. So they have to exit within 2 to 3 years of refinance. So short-term debt, 5 to 10, usually 10-year debt is what we're placing on our new debt is what we're placing on our new properties. And that's not going to force us to selling a shortened time period. So those are in addition to operations, that's probably the second one that we see if you're having a property you're trying to stabilize and you haven't gotten it there and you're in a bad market, you can really put yourself into a corner.
Yeah, that's a good point.
Perfect. Great. Thank you, gentlemen. So we do have a number of individuals that have kind of essentially the exact same questions. So we'll just kind of cut through to, so one that's popping up very frequently is, what's the minimum investment per project? Now, again, apologize just real quick. Again, I want to make sure that the audience does understand that the premise of this was not to create a offering platform for Cannell Capital Partners. So this is an educational platform. Obviously, if you decide to do business with them moving forward, that's obviously between you, the listener, and Cannell Capital Partners to make all those pieces fit together. But again, just understanding this wasn't a promotional opportunity, but there is a lot of interest. So gentlemen, feel free to delve into that. Minimum investment per project or investment.
Thanks, Sean. Yeah, I'll add to what Sean said. We're not promoting any specific project right now, and it's differed slightly on some. Our current minimum investment is $100,000, and that typically maxes out on the project somewhere around $2 million per investor.
Perfect. Great. And also another one that's come up a number of times is, are all of your loans non-recourse loans? And so Chris or Pete, if you don't mind first kind of redefining for the group what the non-recourse loan means and if non-recourse is a part of the debt structure for your group.
Yeah, so Pete's going to talk about this. Yeah, all our loans are non-recourse, and I'll let Pete dive into the types of products that we use.
Yeah, good question. So, yeah, all the projects we have today, it's been agency debt. So we have Fannie Mae and Freddie Mac instruments on our properties, and they are fully non-recourse to our investors, and don't have that personal guarantee component that you would have on a residential property.
Okay, terrific. Great. Excuse me. Okay, so the next question is, good follow-up, makes sense, is the basic gist is, are 1031s needed if you're using a retirement account? And gentlemen, if you don't mind, I'll just kind of touch on this. Feel free to add anything to it that you like. So 1031s, certainly that's, as Chris mentioned, the ability to go from asset to asset and potentially not have a taxable consequence for selling asset A and purchasing asset B with certain restrictions in place. 1031s can be useful even inside of retirement accounts. One thing that we really don't have the time to delve into too much today is that there are structures where a retirement account is involved in a deal using debt, where there is the possibility of a tax consequence, even though it is a retirement account as opposed to an individual. When there is a sale of that asset, there is a possibility for UDFI, unrelated debt financed income. Again, that's kind of beyond the scope of this kind of introductory, this is how to analyze apartments, as this was kind of meant to be. But gentlemen, if you have anything to add to that, feel free to.
Yeah, thanks, Sean. I think probably the most important thing is that moves into any type of investment should consult with an investment and tax professional beforehand. I have certain tax advantages that I take advantage of with this asset class that other people may not be able to, and there may be disadvantages to me or other people that may not apply to other people. So if it comes to a specific question like that, that's something that should be addressed one-on-one and specifically with your CPA. And then as it addresses the specific 1031, is it needed? No. I think the nice thing is this investment, as I kind of tried to highlight, we try to wrap all our returns in the tax benefits, but that's just a sweetener to this asset class. It's got great cash flow, it's got great appreciation, and there are tax benefits that taken advantage of by most investors.
Perfect. So the next question is, how does American IRA work with Cannell Capital? And so essentially the premise, as I mentioned, was for Chris and Pete to educate on the aspect of analyzing and investing in apartment complexes. They've been great to help us spread the word over the years about how investors can use their retirement accounts to invest in all types of real estate, and certainly with a focus on multifamily. Again, we're not promoters, we're not receiving any sort of compensation. We just think it's a great way for clients to hear someone other than Sean McKay discuss real estate strategies. So again, we're not promoting Cannell Capital Partners, but we think that they're a good resource to educate clients on a business model that draws a lot of interest from our clients. As you're aware, at American IRA, we're neutral third parties, and so we're unable to really get too deep into the strategies and to a degree the pros and cons associated with it. So that's going to be the goal moving forward, is to bring on subject matter experts as much as possible so that they can take it to the next level of education beyond just what I'm able to do. Gentlemen, anything to add to that?
I think you said it well. I'll just say this, Sean, I've known you for several years, and I'm doing this webinar today because we've referred investors to American IRA through your services, and I've always been impressed with you personally and professionally. So to echo your sentiments, we do not receive any financial benefits from you directly.
Terrific. Thanks so much, Chris. And obviously, I have Chris and Pete on because I think they're high quality individuals and businessmen. There's certainly many that we can choose from, but we think they're solid individuals. Again, not promoting, but a good resource for clients to learn about apartment complexes. So the next question is, can you please explain non-recourse? And we have touched on that a bit, but essentially non-recourse, just simply stating that to break it down for those of you maybe on a smaller scale, if you're purchasing a single family rental house, if you go to any sort of bank to get a typical conventional loan type product or even a commercial 20 due in 5, you're personally going to be guaranteeing the debt, you're guaranteeing the mortgage, so that if your world unfortunately collapses, the bank can go after you personally to recoup any sort of monies. So certainly the opposite of that is the non-recourse loan, where the investor is not personally guaranteeing the debt. And so if the deal ends up not working out as all had hoped, you are not personally liable for the bank coming after you to recoup any additional monies from that. The next question is, do you use a PPM? And so gentlemen, first, if you can define a PPM for us, and if you do use a PPM for your investments.
Sure. Yeah, the question is, do you use a PPM, and can you define a PPM? Pete, you want to discuss that?
Sure, absolutely. Yeah. So a PPM is a private placement memorandum. It is a detailed document that a potential investor should rely upon to make an investment decision. And so that document's typically going to be 100, 150 pages long. It's going to have details of the investment offering. It's going to have the operating agreement. It's going to have the asset management agreement, all the manager compensation, that sort of thing. And of course, we use that for all of our deals. It protects us as the manager, and it informs the investors of all of the risks, all of the potential benefits, and all the details for the investment. So of course, we would use that for every deal.
Perfect. Great. Thank you for the kind words. Getting some positive feedback about the webinar. Thank you for the non-recourse explanation. Okay, great. So if there aren't any further questions, again, Chris Larsen and Pete Cannell with Cannell Capital Partners. Thank you, gentlemen, so much for giving us an overview of the analysis and what's going on in the apartment world. I think it's certainly a value add, as I said, to have subject matter experts. Looks like that's it for the day. Gentlemen, feel free to, any closing thoughts you have, love to hear them.
Sean, I appreciate the opportunity. And just as a final wrap up, if there are any, I know there's a lot of questions out there about this. I had more questions than answers when I first started investing in this space. That's what I do every day. You can reach out to me. Again, clarsen@cannellcapitalpartners.com. Everybody that's interested to get a free copy of the ebook, and I'm happy to set up a time to dive deeper. And we only work, I'll add the last thing, we only work with approved investors. If you're interested in becoming an approved investor, I can help describe that process as well.
Terrific. Well, thank you all so much for joining us. I really appreciate it. I know it's in the middle of a work day for many of you, so greatly appreciate you taking the time to learn with us and to share your thoughts and questions afterwards. So thank you all again, and we will work to get that recording out hopefully in a reasonable time frame, and keep a lookout for additional webinars and educational opportunities moving forward, and look forward to hearing from you. Thanks so much. Have a great day.